Hello and welcome. I'm Merryn Somerset Webb. I'm joined today by Stephen Yu, who's the Chief Investment Officer of Blue Whale Capital and the lead manager of the Blue Whale Growth Fund. This is the fund's 6th anniversary, and we've got a lot of questions for Stephen. I'm going to be asking Stephen questions that you, the investors in the fund, have submitted about the things that you really want to know about. So he doesn't get to talk about what he wants to talk about, he gets to talk about what you want to talk about. So, Stephen, we've got a lot of questions come in already. Now, there is, by the way, everybody, there is, you can press the Q&A button and you can put in all your questions. I'm going to talk to Stephen for about half an hour, and then after that, we will take your questions. As many as possible, send in anything you like, as long as it's about something to do with finance or the fund, right? We're not going to go outside that. So send in all your questions and we will get to as many as possible. Right, Stephen, hello. Congratulations on 6 years of the fund, by the way.
Thank you, Merryn.
Now, the 6 years hasn't exactly panned out the way any of us would have expected. It's been a difficult time. So I wonder if we could start by asking about what you've learnt over the last 6 years, and if you were to start a fund today rather than 6 years ago, what would you do differently?
Reflecting on our journey over the last 6 years, we have been through a lot, from Brexit, the Fed raising rate back in 2018, then the pandemic, the reopening, and obviously the conflict that's going on in the Middle East and previously in Ukraine. And the world have changed a lot, have evolved a lot. What we have learned over the last many years is our approach in terms of investing into high quality businesses is very important, because that is how you can invest into companies that can transcend some of these macro uncertainties. At the same time, when we started to launch this fund 6 years ago, we really believe into our high conviction approach, investing into the best of 25 to 35 companies. And what we have learned on the back of that is our top 10 or top 15 holdings have done exceptionally well. And I think that's just a byproduct of our research, and at the same time that we should back our high conviction names even more throughout that journey.
Okay, so you wouldn't really do anything differently. You believe in exactly the same things you believed in at the beginning.
That's right. Of course, obviously, the world have changed a little bit over the last 18 months, and it's important from the investment manager perspective that we evolve with the new regime, which means that our investment process, investment approach remain unchanged, but the opportunity set would need to evolve, which I'm sure we'll talk about some of this later.
Okay, so the recent underperformance, is there anything that tells you about how perhaps you should change your approach?
So that is a very important question to address, and we did a lot of analysis on the back of that underperformance in 2022. So if we look back to our performance since inception in 17 until December 21, the performance has been very good. And the first 6 months of last year, the performance was very bad. And since July last year until recently, the performance has recovered quite strongly. And if you ask me to attribute some major contributors to the level of underperformance last year, was due to the one-off rapid interest rate reset in the US in particular. And when we invest into a company, we do take a medium-term view with at least like 3 to 5 years. And sometimes it's very difficult to time the market. I think that is something that we've learned that is very difficult to do, if not impossible. At the same time, that you need to sit through with the company over time, as long as the macro uncertainty, including interest rate increases, have not impacted the company fundamentals. You should back those companies. And Microsoft would be a good example, that last year the shares was down about 25-30%. I think we spoke about that in October last year. And recently, if you look at the share price, it's recovered most of the losses. It's very close to the peak now. So it's just one of the things that when you invest into a company, you're investing into the shares of a company, which is linked to the stock market. And sometimes the share price volatility could cause a hit in the short-term valuation of a company, but it doesn't change the long-term fundamentals of those companies. So it's important to stay within that remit.
Okay, so when you look at the higher interest rate environment, and why don't we start by asking if that's what you expect to continue? Do you expect us to continue to see interest rates at this kind of level? And if so, is there a way to position the fund to benefit from that, or at least not to suffer from it? Because while high interest rates might not affect some of the companies' operations in themselves, they might affect longer term the way the market values those companies.
So our base case scenario is interest rate is going to stay higher for longer.
Right.
We have been saying this since last year. I think that is likely to be quite true now if you follow some of the central bankers' commentary recently. And on the back of that, it's very important that you invest into a company that are mostly net cash on their balance sheet. So such as some of our most of our company in our fund would be net cash, so that they are not at risk of refinancing at a much higher rate if they are indebted. So this is a starting point. Secondly, the reason for a higher level of interest rate for longer is because inflation is going to be a lot stickier than before on the back of the geopolitical uncertainties, which link to the energy bills going up, mortgage rates going up. At the same time, of course, we still have a shortages of workers. So you would expect rates to stay high for longer. And what it means is, from an investment perspective, that we are very cautious about consumer-facing businesses, in particular if those businesses are exposed to consumer discretionary spending. And I would expect that our pockets or wallets would remain under pressure in the next coming years. So you want to avoid companies that are selling discretionary services or products.
Yeah, companies without pricing power. Yeah, I suppose one of the big questions here, in fact, probably the only question on everyone's minds at the moment is what everybody wants right now is to be able to beat inflation, or at very least to maintain their purchasing power. So you want to look at their portfolio in terms of it being positioned to help us beat inflation over the medium to long term.
So the thing about investing into the stock market is, if you look at the long-term history of, let's say, the US stock market, that it has, the return profile has beaten cash over a long period of time. But of course, if you're looking at the interest rate regime recently, or investing in gilts, like, they are giving you quite a lot of return, about probably 5 to 6% within a short space of time. But what is different if you ended up investing into a company with strong pricing power, such as MasterCard or Visa, that they are net beneficiary on the back of high level of inflation. So they do make more money on the back of high level of inflation. So we would expect a company like MasterCard or Visa would be able to deliver a higher level of return than your cash, because ultimately, even if you're getting paid about 5 to 6%, we know that in the UK, the inflation number is close to 7%, so you're still losing out a little bit. And it's important that you invest into a company with strong pricing power, hence they would be able to get the benefit, if not being impacted by the high level of inflation.
And you're expecting inflation to stay reasonably high. We talked about interest rates, but inflation as well.
So over the shorter term, let's say up to 3 years, we would expect inflation level to settle down at a high level than pre-pandemic. So pre-pandemic, we have a long period of time that that inflation was at about 2%. We probably would expect inflation to settle down about 4% on average, let's say in particular in the US. But of course, the inflation number is a calm number, so you could easily get number back at 2%, but then it come back up to 4%, but on average could be about 4% ranges. In the UK, I think we have slightly higher issue. If you look at the recent data, that I would expect the UK level of inflation would be much higher than 4% over the shorter term. The other thing which is interesting, I'm sure we'll talk about this later on, is AI or automation is going to come into play in the medium term, which is probably in the next 5 years, and that would be deflationary. That would take inflation back down to 2%, but it's just not over the shorter term period.
Okay, well, why don't we stick with talking about that? You've had a lot of attention in the press for your investment into AI, and it's one of the great things might be that this is kind of technology that gets rid of this inflation overlay we have on everything. But what are the other attractions for you? What's the driver of investing in that sector?
So AI, artificial intelligence, which we had talked about over the last many years, is not new. What has been new is generative AI, which I'm sure some of our audience would have used the ChatGPT that came to the market sometime this time last year. And that has been quite game-changing. And Jensen Huang from Nvidia have suggested that the arrival of generative AI is similar to your iPhone moment back in 2007. So it's as game-changing as that.
Can I interrupt you briefly to ask you to explain to us exactly what generative AI is?
So the difference between probably what we understand about AI previously versus what we are experiencing today is previously AI is only available to the scientists, the software engineers. And when we talk about AI previously, we typically talk about the recommendation systems that we have experience with, such as if you go onto YouTube, you watch a video, within 1 or 2 minutes, you get recommended a new video, or TikTok, or you go to Amazon to do your shopping, and then certain items get recommended to you. That is computing done in a real-time basis, looking at all the data that has been available in terms of your history and what else is out there. So that is the AI previously.
Yeah, we've all got used to that. We're very accustomed to that now,
correct.
to living with it and being mildly irritated by it. Yeah.
But what has been quite new is generative AI. So ChatGPT would be a good example. This is the first time that the mass market, which is us, the consumer, can utilize AI to get some work done for us directly, right? Like you can go to ChatGPT not just to ask a question, you can ask ChatGPT to help you to correct an essay, to come up with different suggestions, what can be done better, or different recommendations. But what is even more powerful, which is yet to come as we speak, is the Copilot that is being launched by Microsoft and also Adobe. So Microsoft have recently launched this Office 365 Copilot, which is what it could do potentially is you can ask this Copilot within Office 365 to do the work for you, such as you want to build a presentation, build a PowerPoint with all these pointers, and then you just basically have certain command to say you want this to be built, and it will be done for you within seconds. And this is very different to the AI that we talked about previously.
Okay, so this is the shift that might really give us the productivity revolution that we've been waiting for. You know, we've had all these amazing technological shifts over the last couple of decades, but we haven't seen them translate into a huge leap in productivity. We've been waiting for that for some time. So is generative AI the thing that actually gives us this increase in productivity?
Yes, this is exactly the point, that we do believe that we are going to experience a repeat of the industrial revolution, which mostly happened in the manufacturing space, but we are going to get that in the white collar domain in the coming years. So some headline number have suggested that, oh, the AI opportunity is about $1 trillion or $2 trillion. But what does it all mean? People have been questioning, like, where's all this number come from? It's actually very simple to understand that. So globally, we have about 1 billion knowledge workers. So anyone who uses a computer to do work, including people like us here, and then people might work in India doing the call center. And if you assume that on average, people get paid about $20,000 a year, so people in here, we would be paying a lot more than $20,000, but people outside of the developed market would be paying a lot less. We get paid a lot less. So, but if you assume it's on average, people get paid about $20,000 a year for about 1 billion workers. In order to justify $1 trillion of opportunity, all you need is to reduce the global headcount by either 50 million people, which is 5%, and 50 million people multiplied by $20,000 is $1 trillion of opportunities, or you increase productivity by 5%, which is also get you to $1 trillion. So we are going to have a lot more efficiency within the white collar domain that we have not had experience previously, while we have gone through the third industrial revolution and all this automation. If you go to a factory now, you don't see many people walking around in the shop floor. You see a lot of robotic arms doing the work, and we would expect that to happen in the white collar domain in the next coming years.
And then what happens to all those white collar workers? The downside.
So over time, of course, this is going to be a journey, but over time we will expect that we will have fewer jobs within the white collar domain for people who would want to come into the white collar domain. And especially if you look at the worker shortages that we have experienced since Brexit in the UK or over the last many years, is we have lack of people coming into the blue collar domain, like working in the hospitality industry or being a craftsman, working in construction. And over time, we would expect that some of the lower entry level jobs within the white collar domain, that people would actually be incentivized or get paid more if you go into the blue collar domain. So I think that's going to be a rebalancing of the economy in terms of how people, which sectors people go into to seek work over time.
We could finally get our 3-day working week for everybody. It wouldn't be all bad, would it?
Yes, unfortunately, I think the challenge to that is we have talked about this in the UK, that I think in certain government agency that the agency is suggesting people should work 4 days a week while getting paid 5 days a week. I think it's likely that we ended up working fewer days over time, but it's a big question mark whether we still get paid the same if you work less days.
Depends how productive we are, doesn't it? Right, let's move on to Nvidia, which is one of the big companies that you've talked about a lot over the years. Now, there are fears that it's overvalued, has been overvalued, and that it might be time to get out. I wonder if you could talk about Nvidia's role in the AI revolution and where you stand on it at the moment.
So Nvidia has been one of the most misunderstood stocks in the stock market since we initiated a position. And if I take you back to the journey when we first invested into Nvidia in June 21, that Nvidia's market cap was at about $500 billion. Then later in 2021, Nvidia's market cap peaked at about $800 billion, and recently has gone above $1 trillion. Of course, last year was a disaster because the shares was hit quite a lot, and we talked about that last year, but recently it is a recover. So what does that actually mean? So back in 2021, we were talking about the AI, which are slightly different to what we're talking about today, that we were very positive about the development within the AI space, or what Nvidia is doing within the space, which is selling the mission critical equipment, the GPU within the data center, that computing can be done on a real-time basis. With the new development that we have seen recently, that we are even more positive about how Nvidia is going to play a role within the AI domain. So there are a few statistics that I can share on this to talk about valuation, why we think valuation remain quite attractive. So firstly, when we talk about AI within data center globally, including the global cloud data center, AWS, Azure, and Google Cloud, only about 6% of the data center are being accelerated today. So accelerated means that you would have some sort of Nvidia GPUs or other GPUs in it that give you accelerated computing. The opposite of accelerated computing is your CPU, which we have that on our PC at home or laptop, that you do know that is quite slow in terms of doing different things at the same time. Like you use it for the general purpose computing, but not for a specific task. Based on our forecast and understanding on how the development can play out in the next 5 years, our numbers only get to about 12% globally. That we would think in 5 years' time, globally, 12% of the global data center would be accelerated compared to 6% before, today. Then the first question to ask is that realistic to get to 12%? We think it's quite realistic. 5 years from 6 to 12 is not a lot. The second question to ask, which is even more important, but we can't give you an answer today, is what does it stop at? Does it stop at 12%? Is it the end to that acceleration, or do you believe that number could be 20% or 30%? Of course, we don't know that today. We'll track the development quite closely. So using this assumption to put it into our valuation model, that we are significantly ahead of the market expectations on how much money Nvidia is going to make in the next couple of years. At the same time, the valuation in a few years' time is very attractive for what it's offering. And if you go back to all the narrative about generative AI, in order to make this happen, Nvidia is the only company in the world today that could provide you with such a capability. So then the question to ask is, are we going to take our time to adopt AI, which as far as ChatGPT is concerned, that it has been the fastest adoption ever to get to 100 million users within 2 or 3 months compared to previous cycle. And then secondly is how quickly some of this technology would get rolled out, which we have seen from ChatGPT, the Microsoft Copilot, Adobe Firefly, there's many others to come that is actually happening a lot quicker than anything that we've seen in the past. So we do believe that our forecast in terms of how much money Nvidia would make in the next few years would make the valuation very attractive.
Okay, and what are the risks of that? You say they're the only company that can facilitate this. Is there no genuine competition?
There's no genuine competition. Obviously, over time, we would not expect Nvidia to capture 100% of the market share. I mean, we would factor into our model that we would think over time that is going to be a competitor coming in. AMD is, for example, is going to launch a product themselves later this year. But what Nvidia has done over the last 20 years is they have come up with this mode, which is the programming language called CUDA, C-U-D-A, that you would need to learn the programming language to be able to program that capability within the Nvidia GPU. And that programming language has been taught in school, and anything that's happened within the AI space, people who know about AI would know about this language. If you do go into the AMD product, which is the end of launch, they would be a completely different language. So firstly is how easy you convince people to learn a new language. It's a bit like your app store. Like you and I could start up a new app store to compete with the iOS app store or the Google Android app store, but no one is going to use our app store because all the software developers who has been learning about how to write an app in the iOS or Android domain, they will need to learn a complete new language. So what CUDA have done for Nvidia, which they come up with themselves, is their own programming language, is about a bit like your iOS system, is going to help them to strengthen their competitive positioning over time. But we would expect some competition would come in, but it's going to be less significant than what it might be. And also it would take some time for that to happen.
Okay, so the competitive risks are low. Okay, now that's a very exciting business, and you said at the very beginning of your investment there that you would have expected Nvidia to become $1 trillion company. Is there something else out there that you see that might have a similar trajectory that the rest of us haven't yet noticed? What's the next $1 trillion company?
So we did tip Nvidia to be the next $1 trillion company last time we checked it back in October. If you look at the generative AI space, what companies are going to benefit on the back of that? So firstly, we have identified Nvidia being the infrastructure play because you need to have that GPU to power the technology or the applications that's yet to come. Then the second leg to that would be the likes of Microsoft, who is offering an add-on onto their services that we are already using that's going to make our life or work more productive. But the third leg to that would be company that has a lot of data about us, that they could utilize the data or the knowledge that they know about us to translate that into business opportunity. So then the company that have come to mind is Meta, which via the kind of family apps in WhatsApp, Instagram and Facebook is they do have got a lot of our data on that system. And in time, which we know that they're working on certain AI technology now, is going to come into play to utilize some of this data set. So obviously Facebook or Meta had been a $1 trillion company before, and at the moment is short of probably 700 to 800 billion. But if we want me to tip which company might come back into,
yeah, that's exactly what I want.
And then Meta could be a strong candidate.
Okay. A reminder, by the way, everybody, do please send in your questions. I want to go to Q&A, and not enough are coming in. This is a unique opportunity to ask Stephen questions directly and have them answered. So do please send in your questions, although I do have quite a few more, so we can carry on. Now, one of the other questions that has come in is about Charles Schwab, which is a company in your top 10, but hasn't done particularly well over the last year. So can we talk about why you have that investment and what you expect from it going forward?
Charles Schwab has been one of the worst performing stocks within a fund this year. And at the moment, it remains in our top 10. So we still have conviction behind the thesis. So what has Charles Schwab gone through was that its earnings or the valuation has been dragged down to start off the year by the regional banking crisis in the US. So the likes of SVB that disappear, and then that have dragged the entire banking sector under the water, taking Charles Schwab alongside it. But what has actually happened behind the scene, there are two things that happened. So firstly, Charles Schwab is the largest investment platform in the US with about $8 trillion AUM. So this is very, very big number. And since the regional banking crisis started, Charles Schwab have seen more customers moving their account onto Charles Schwab. So firstly, Charles Schwab have not lost any customers on the back of that. Secondly, in terms of the customer base, they are relatively wealthy, that their average portfolio size is about $200K dollars. And at the same time, they hold about 10% cash within their portfolio. So what have actually impacted Charles Schwab on the back of that is not the business model per se, that because of a new competitor coming in or Robinhood, which obviously is not the case. It's about customers has been sweeping some of their cash balances onto money market funds, which I'm sure we have experienced that in the UK. And we would believe that that journey of sweeping the cash in the money market fund is approaching the end, that we think that now we have come to a balance of people who have about 10% cash, which is about $20,000 out of a $200,000 portfolio, that at the moment is about 50-50 split. So about 10K of that is in cash and 10K of that is in money market funds. And of course, you have to remember that Charles Schwab is an investment platform. There's a good reason why you still want to hold a level of cash so that you can make transaction quickly, rather than you buy into a money market funds. It might take you a few days before you get your money back, and then by the time you want to invest into the market might be a bit too late. So we do believe that the sweeping of cash in the money market funds has stabilized. Of course, it's not clear yet, that we're tracking the development quite closely on a weekly or monthly basis. But if that is the case, then Charles Schwab is going to benefit on the back of high level interest rate, because when you look at that portfolio of mortgage-backed securities, which is backed by the US government, that the duration is about 4 years. So every year they are able to deploy 25% of that asset into high yielding asset. So if we can if the split remain unchanged between now and this time next year, then they would be making a lot more money. Okay. So we do think the thesis remain intact.
So you're very happy to hold it, continue to hold it. Yeah. Another one that has been in your top 10 that people have been asking about is Adobe, which has made its way back into the top 10 after a short absence. I wonder, we're being asked, what has changed for you to hold it in such a high conviction position again?
Adobe has been one of the most beautiful companies that we have had in the fund since inception back in September 17. So we have held Adobe since September 17 until today. What have changed in that journey was Adobe has been featured consistently in our top 10 until Q2 2022, which is last year. That it fell out from the top 10, so people no longer see that on our top 10, but it remained a position in the fund. The reason for that was that we had some concern about its underlying markets within the creative professional space, that there's some weaknesses there when we talk about consumer spending. And then secondly, we weren't very happy with that Figma deal, which they did later in the year, that took the share, basically the share price got hit quite badly on the back of that. And we thought the management team have not deployed capital very wisely. So we were monitoring the position quite closely. But what have changed recently is generative AI. And if you are a creative professional, you would have used the new product from Adobe, which is called Firefly, that instead of you being a creative professional, you need to learn all the techniques about doing the different filtering, trying to crop out certain character and maybe insert certain scenery and color themes to to your photo or campaign, that you can now just type in a command to say, I want to change the backdrop from an office environment to the beach environment. I want to remove all the characters with the exception of myself, and I want to change my outfit into some summer outfit from winter outfit. You can just type in the command into Adobe without doing it yourself, and it will be done for you instantly. So that is very new. And on the back of that, which is very important, is we would expect there's going to be a further explosion of contents because of such a capabilities. And as you can imagine, in the digital advertising world, we have talked about this over the last many years about individual ads. Of course, that is not easily doable. But what advertisers have done is they try to create different campaigns for different audiences in terms of the demographics, the ethnic group, etc. But with this new capability, we would expect that over time, we will be seeing individualized advert across different products. And this is going to be very powerful. And of course, I'm sure that if we are seeing something even more personalized to us, that our intention to buy the product or services would be a lot higher than seeing something that is relevant but not directly relevant to the individual.
Finding that slightly worrying. You're not painting something I'm looking forward to. Are you worried, Stephen, that AI is going to end up taking your job?
This is something that is very close to heart. Obviously, one thing we have reflected throughout the last 6 years is how can we ensure our competitive advantage to remain. And if I look back to my previous career over the last 20 years, there's many things that have added value previously. Let's say brokers research, speaking to sell side analysts, that are no longer giving you the value add today. Not because those research are bad per se, but it's just because the research is readily available to anyone who can have access to it. So in today's context, our competitive advantage come in the form of doing fundamental research. There are 6 of us on the investment team that we are doing research day in, day out, just focusing at about 25 companies. And if you do the math, the level of work that we have done behind the scenes per company is quite significant versus, let's say, if you have 2 people covering 25 stocks, or you have 5 people covering 100 stocks, like we have 6 people covering 25 stocks. So that mathematically, we just end up doing more work. But of course, on the back of the generative AI, I'm sure some of our work could be done by the co-pilot, if that's going to come in time, that a lot of people would be able to do a decent level of fundamental research, which we are doing today, that we pride ourselves as our edge, that we would need to evolve over time. So the answer to the question is we don't know how it's going to play out yet. But one thing is very important is whatever we're doing today in terms of the investment process to have a competitive advantage will need to evolve over time. So if there's such a thing as generative AI coming out with the different thesis on company doing the balance sheet analysis, we would adopt that. So how we can add the additional leg of value on top so that we can do better than our competitor, I think that's yet to be seen. And that have not changed in the market. So I would hope that if we can continue to deliver the values, then we would still have a job. If we couldn't do that, then we would be on the way out.
There's always the personal element, the one-on-one of meeting management face-to-face and that kind of thing that generative AI can't take over. Or maybe it can at some point. Let's talk a little bit about some of the other companies in the portfolio. And it's a very concentrated portfolio. We've talked about 3 or 4 of the big names. Are there any others that you would like to bring up and talk about specifically? Favorite companies. I know you're not allowed to have favorite companies, but any that are particularly interesting.
I think the world have changed a bit. At the moment, it's actually quite a difficult environment that we would expect to remain in place for the next many years. And it's very important that either you pick companies that could transcend some of the macro uncertainties, such as the geopolitics, the inflation, that they can continue to sell more of their products or services to enterprises or consumers. So the likes of Nvidia, Microsoft, Adobe, we think that those companies would do quite well on the back of that. But secondly, that because the world is quite uncertain, then if you can find company that could benefit on the back of the uncertainty, this company would do well too. So within our top 10, we have company like Canadian Natural Resources, which we talked about last year, that they would do well on the back of a higher oil price or sustained high level of oil price going forward. At the same time, we're showing opportunities such as silicon sovereignty, like Lam Research that sell mission critical equipment to foundries, that we would expect them to do quite well because the government are supporting the spending in terms of tax subsidies to build foundry closer to home away from Asia Pacific. And so we are excited about this company, but the problem with all these opportunities is they are quite limited in the current world regime, that because of the challenges, because of the headwind, that we struggle to find more companies that could benefit on the back of either of this.
Are you beginning to look more at political risk? And one of the great joys of the last 30 years is that you haven't had to take geopolitical risk into account when investing. And now in the US, the UK, in fact everywhere, there is political risk again. To what extent do you take that into account when you're looking at your investments?
So geopolitical risk, that is a very strong theme within the fund, that we want our company to be able to transcend some of the geopolitical risks, or they would actually benefit on the back of those uncertainties. And this is just one of those things that we talk about, that we are in a new regime going forward. I mean, unless you think about that either Putin tomorrow might kind of become friends again with Europe, or maybe kind of the sea in China is no longer going to go into a different direction, that everyone become friends again, which means globalization would remain back in place, that we don't think that's going to happen anytime soon. Like this geopolitical risk, uncertainty, or including the conflict in the Middle East now, is just one of the normality that would expect to come going forward. So it's very difficult to find company that doesn't get impacted. And if you can find those companies, then you want to stay with those companies. But those companies are only a few that could do well on the back of those risks. But you need to consider that.
Okay. Can we talk briefly about the geographical location of the companies you invest in? You're not a US fund, but you are nonetheless very, very US focused. Are you comfortable with that in this volatile environment? And particularly, I know there are lots of questions about, are there companies in the UK that you might find interesting on a quality basis?
So we are agnostic about where we invest our money. At the moment, we have about 2/3 of the fund investing into North American businesses and companies. And of course, if you look at our top 10, you will see some of these names are very big global companies. They are American companies, but they are global businesses like MasterCard, Visa, or Microsoft, and some others. So we are agnostic about where they are listed. But it's important to go back to the point that I made earlier, that these businesses have a strong moat, that they are very well positioned on the back of everything that we talk about that is of a concern. And they could continue to go through the cycle without being impacted. And most of these companies are net cash too. So we don't need to worry about them refinancing on their debt because they don't have any. They actually would get paid more on their cash balances in the bank. And so we have that. I think in terms of a company outside of North American region, let's say the UK, it's not easy to find many, just not because that our company are the UK businesses are less well positioned, but more to do with the fact that they are more silo in terms of their global kind of impact or global exposure, that most of the businesses in the UK outside of FTSE 100 would be domestically focused. And of course, if you ask me what's our view on UK economy, we are quite cautious about the UK economy just because our inflation number is a lot higher than the rest of Europe and at the same time the US, and our disposable spending is going to get further squeezed going into the coming quarters and years. So hence it's not easy to find a good company within
a company
the
that
UK.
can weather that environment successfully
yes,
with only a domestic outlet. Interesting. Do ask more questions. We have a few more minutes, so I can take a couple more questions. I'm doing them at the moment, but send in more if you have them. One question related to the US equity holdings is there any currency exposure in the fund? Currency hedging of any currency exposure?
There's no currency hedging in the fund. The fund base currency is in sterling. 2/3 of the fund is in North American companies. So we do have a big exposure to the US dollar. And if you expect US dollar to remain strong relative to sterling, or being a natural hedge to weakness in sterling, then the fund would do well on the back of that. That is just on byproduct of our bottom-up stock picking.
Okay, so inside the fund, anyone who invests in the fund has currency exposure at the same time, is really the question. Yeah. Okay, there's another subject that keeps coming up and will continue to come up, which of course is about ESG overlay on funds, environment, social and governance. And so one of the questions is, how do you look at the ethical environment as opposed to the ESG environment when you're investing?
So we look at ESG factors as business risk factors to how we assess whether a business model is sustainable over the medium term. So this is what we look at. This is how we define a company being high quality or low quality. Of course, the fund is not a high impact ESG fund. We're not actively seeking on a company that is going to make the world greener, but we want companies that are quite in sync with what's going on in the world, because if everyone is going to care about the environment, care about the social impact of what company are doing, then you want your company to be doing that too. And our company are doing that, because not only that they're high quality, at the same time the management team, which is something that we do rate quite an important factor to in our process, that they are high quality management team, which means that they are more likely to do the good things that either not just to reward the shareholders, but at the same time to make the business model sustainable over a long period of time, rather than you just make a lot of money in the next 1 to 2 years, but then every regulator is going to come after you in a few years' time, and then that destroy shareholder return. So it's a byproduct of how we think about high quality businesses. So it's important. And at the same time, if you look at the composition of the fund, of course, it's a global fund, that we have very little exposure to emerging markets or to places that we have concern about the the ethical or corporate governance side. So hence, it's also a byproduct why we ended up with a lot of our exposure to North American companies.
Okay, so it sounds to me like when you look at ESG, you're really focused on the G, with the assumption, I think correctly, that if a company is very well governed,
Yes.
the E and the S will effectively follow, because that's part of long-term good governance. Is that fair?
Yes.
Yeah. Okay. There's a couple of questions about recession. You talked about your concern about the UK domestic market and the recession possibilities here, but isn't the US equally at risk of recession at the moment?
We are not overly concerned about the risk of recession on the impact on our fund. Of course, if you're just talking about the stock market or the economy per se, then it's a concern on some businesses or some sectors. But when you look at the company that we have in the fund, that they are relatively immune from the risk of a recession, we would expect when a recession is yet to come, is a normal course of an economic cycle, right? Like every cycle would go through the boom and bust, or maybe like going the economic boom period. At some point, that might be a recession. In the US, it looks likely that it's more going to be a slowdown or mini recession than a severe recession. Because what you don't want to happen is we go into a severe recession or depression that might take many years to unwind. That, of course, is going to be bad for businesses. But if it is just a normal course of an economic cycle that it lasts for 1 or 2 quarters, which is what the definition of recession is, then it's fine, because ultimately our company would will be able to transcend the recession, and hopefully they might be able to take further market share because they are able to grow on the back of the weaker players in the market in such an environment.
Okay, so let's look then at the threats to their portfolio. We've talked a lot about the importance of high quality and the fact that you wouldn't change the way you invest, etc. But over the next couple of years, I accept that over the medium to long term, everything we're talking about is a lot of the technologies and the companies are incredibly exciting. But over the next 4 or 5 years, are there any things that worry you? What's keeping you up at night? What are the risks and the threats here?
Our base case scenario is we expect geopolitical uncertainties to continue. Of course, this is a very big topic, and we have, over the last 18 months, we have already experienced 2 incidents, one in Europe and one in the Middle East. And hence, it does cause a lot of volatility in the market that make people concerned about. They might want to hold more cash on the back of that rather than invest into the market. But what we have seen, at least over the last 12 months or so since the summer last year, is if you ended up investing into high quality businesses or companies that can do well or not getting impacted directly, you can still make money on the back of that. So then to go back to your question, what might be the concern? Of course, that's this. The big elephant in the room is whether something is going to happen in the Asia Pacific region. If it does happen, of course, it's going to be much more significant than what we have seen in Ukraine or in the Middle East. Okay, whether it's going to happen, how imminent it's going to happen, how it's going to play out, we don't know. But that is something that would be on the back of our mind, that if it does happen, then maybe we want to be prepared for that.
How do you prepare for that?
You can't I mean, ultimately, it depends on the magnitude of the event, right? Because there's many different scenarios how that could happen. Like it could be a piece, I mean, if you're talking about Asia Pac, then we're talking about Taiwan and China. It could be a peaceful unification. I mean, all subjected to how this election is going to play out. If that's not the case, then is China serious about taking back Taiwan by force? Like how significant that is, what is the time frame? Because if you ask me personally, if that incident happened today, it would be quite disastrous. I think I would imagine the Chinese official are sensible on this. They might take their time to play this out, and over time, if you really play this out over a long period of time, that it might be a non-event because maybe people want to see this to happen. We don't know that, so it's just one of those things like you need to be cautious about. And hence, when we look at our investment in the fund, that we have very little exposure to China. Right. Whether it's directly, we don't have any direct investment in Chinese company, and on an underlying exposure and market basis, that we don't have a lot of exposure to China. I think that's something that we are very cautious about, that we are still very centric in the G7 of developed market, but ultimately it would impact the world. So we are not pretending that if it happened, like nothing is going to happen here, like things would happen.
But your base case remains that regardless of what happens anywhere, solid, high quality, reasonably priced companies will do well for us over a 5-year period.
Yes, and also it's important that people need to remember every company would go through cycles. Like the regime is very challenging. It will remain challenging in the foreseeable future. What you would want to avoid when you make an investment is the company that you invest into could disappear on the back of those uncertainty. So let's say if this scenario plays out in Asia Pac, and certain company that are overly reliant either in terms of how they make money or the business model that is very dependent on that relationship could just disappear. And if the company disappears, then you cannot recover on the back of that scenario. But if your company are very well positioned or being net cash on the balance sheet, which is important, that you would go through the cycle, but then you survive. You survive the cycle, then you come back stronger. And I think that's very important to remember, that your company would be able to sit through the cycle, which we call them the transcendent companies that could do okay on the back of.
Okay, so this is the key: transcendent companies.
Transcendent companies.
Stephen, thank you very much. Absolutely fascinating. And everybody, there will be a recording of this, so you can review it later at your leisure. Thank you.
Thank you.